G'day guys, welcome to another episode of Catapult Wealth Market Update. Today we've got the honour of having Scott Kelly. He is the Portfolio Manager of DNR Australian Equity Income Fund.
Thanks, good to be here.
Scott, you've got about 21 years experience in markets. You've held analyst and director roles with Macquarie Bank, UBS and Morgan Stanley. With all your years of experience and you've seen it all come and go, the markets at the moment, they're in uptrend. We're seeing such strength. It's crazy how all this banking fear and stuff, which seems to have faded. The US, debt ceiling stuff, people are sort of not worried about that anymore. Given that, what do you think we're looking like for a soft landing? Because that seems to be what equity markets are pricing in. How likely is it that these interest rate rises by the central banks aren't going to flow on and cause, a big recession?
Yeah, sure. Look, it seems at the moment that bad news is good news and good news is good news as far as equity markets are concerned. But look, the way that I like to think about the macro is in terms of scenarios and probabilities. And I think you're right that the equity markets seem to be ascribing the highest probability on the soft landing scenario. And whilst that is a scenario, it may not be the most likely scenario. We think that there are other scenarios. The two that I think might have a high probability are that we end up in a hard landing scenario, or the recession scenario, where unemployment rises 100 basis points and causes double-digit earnings declines from where we are today. Or the third scenario is that inflation and therefore interest rates end up being higher for longer, i.e. Inflation is stickier. And in that scenario, central banks have more work to do in terms of higher interest rates, or maybe staying where they are for longer than currently expected. So, while soft landing scenario is a scenario, and certainly, indicators appear to be that the economy has been handling higher interest rates relatively well. There are signs, you mentioned US regional banks, albeit that seems to be contained or isolated. But then there's unlisted commercial property, which could be the next domino to fall. It's one thing we do know is that when interest rates do go up as quickly as they have gone up, historically, that has created problems. And so I think it's prudent to be cautious in this environment. And certainly that's what the bond market is telling you right now. Equity markets are always more optimistic, and that's what we're seeing in terms of the run that we've had this year and what's been priced in to certain stocks.
Yeah. And this slowdown is being artificially created, right, by central banks. And so they just want to see inflation come down relatively rapidly, which isn't happening so far.
Yep.
And so even though we might see a recession in the US, it doesn't mean a giant recession. It just means a rapid slowdown, because that's what they want. Because the job markets are so strong.
Yes.
But what they really want is just guys to stop spending. That's it. So just stop spending, let the prices come down, and then they're happy, then everybody's happy.
That's right. And look, interest rates are a pretty blunt tool. But you mentioned the employment market, and really that's the key to all of this. Employment market's very strong in the US and here in Australia, and ultimately getting employment having higher unemployment is ultimately what the central banks need to get inflation back to that 2 to 3% range. And so far, employment markets have remained robust, and that's because everyone was sitting on a lot of cash post COVID primarily, and there's a lag effect on higher interest rates, we have seen interest rates here in Australia go up significantly, but it's still working its way through the system in terms of being passed on through high mortgage rates, and then of course there's the well discussed mortgage cliff coming in terms of all those fixed rate loan holders that are still to transition to higher rates.
Well, we're basically right in the middle of that transition now. It's happening as we speak. Given that, because what a lot of our investors want to know is, what's going to be the effect on dividends? So, we've seen some crazy dividends from the banks and, the miners and oil and gas. Fast forward to sort of 6 months' time, what do you think yields are going to be? There is a little bit of risk to earnings here. What do you think the dividend payout rates are going to be like?
Yeah, so I think a couple of things in that. Firstly, generally dividends follow earnings. So to the extent that earnings might come under pressure, then you might expect dividends to come under pressure. That's at the market level. But within that, of course, you've got the different sectors that are delivering different outcomes based on the drivers for each of those sectors. Iron ore prices still remain very robust at around $110. And that should allow the likes of BHP and Rio to continue to pay above market dividends. The caveat being that they also want to invest this cash flow into new energy investments. So it wouldn't surprise me to see BHP and Rio payout ratios come down from where they have been over the last couple of years as management look to deploy some of that cash into diversifying away from iron ore and other commodities into the new energy streams. I think the other point to note is that payout ratios post-COVID are still lower than where they were pre-COVID. This is for the market generally. And that's mainly because management teams have elected to be more conservative given all of the uncertainty, and that's rational. But what that also means is that potentially there's less downside to dividends because management teams are giving themselves more breathing space in terms of the lower payout ratios that we're seeing across the board. So look, there are a few comments. You mentioned the banks as well. We're very cautious on the banks at the moment. We see a lot of headwinds facing the sector generally. Competition is fierce in both mortgages and deposits. Both are important. And that's seeing net interest margins peak and now start to retrace. Not only that, but you're seeing higher inflation impact the cost base, where labour is almost 2/3 of the bank's cost base in general, and higher wholesale funding impact the costs as the government funding facility rolls off this year as well. So all of these are big headwinds for the banks over the next 12 to 18 months. Not to mention the potential for a bad debt cycle. I say the potential for because the reality is that we've never had a residential bad debt crisis previously, and that's right. I don't think we will necessarily have one this time because I think the banks will work with customers to transition to interest only or work with those customers that are finding it tough. But nonetheless, we think that there is the likelihood of consumers to come under more pressure as they roll off their fixed rates and the higher interest rates bite more. We think that we're in the middle of it or it's still to come over the course of this year. So we think that there are better areas in the market than your banks and resources to find income sources, certainly over the next 12 months and with a view to 3 to 5 years. Yeah,
so basically to summarise, look, some of these companies have still got abnormally high earnings, like iron ore and energy. The margins are really high, and even though they might come down a little bit, there's still plenty of fat there to pay out. So the dividends might come a little bit down from really abnormally high levels to normalised levels to maybe a little bit lower than average.
Yeah.
But there's still lots of good stuff there. But as always, it's an uneven market. Some industries are going to be strong, some are going to be weak.
Yeah.
Some are already inflated, and some are just going to come back down to.
That's right. And look, using equities as a source of income makes sense for a couple. If you stick cash in the bank account, you're actually getting return today 4.5% or so, just sitting in a cash account. But inflation's at 7%. You're still going backwards.
Right,
so
just slower.
Equities which have a growing income and capital growth and yield growth over time, we still think is a reasonable place to be seeking income. Income, is generally resilient and stable. It's the share prices that can be volatile. Yeah.
Last question. Given that there's three scenarios like you said, hard, soft, and then maybe just the central banks kind of give up on their mandates and just allow higher than targeted inflation for a while.
Yeah.
What are the sectors you like at the moment?
Yeah. No, it's a good question. I think with those scenarios in mind, I think the portfolio tilts that we have currently are weighted more to being somewhat cautious, given the potential for the hard landing scenario. But as importantly, if not more importantly, ensuring you have inflation protection should inflation prove to be stickier for longer. And so within the defensive or the cautious side of the market, the key is not hiding in the same holes that everyone else is hiding in. We don't have Coles and Woolies in our portfolios, but what we do like is something like the Lotteries Corporation. And I always like to compare the lotteries to Transurban because both are monopoly assets, both have pricing power, both are capital light models, both are relatively defensive assets, albeit 30% of Transurban's revenue these days is heavy vehicles. But Transurban's trading on 25 times EBITDA, and Lotteries is trading on 15 times EBITDA. So we much prefer the Lotteries, not just from a bottom-up, from a top-down perspective, but more importantly from a bottom-up perspective. We think that there's still significant value in a stock like Lotteries, and you're not, buying the same name that others in the market are. So, stocks like IPH, or Endeavour Drinks, the telco space is another area that we think have very strong, industry. You've got a rational mobile market for the first time in 5 years, where all three players are putting up prices. Telstra is the last telco to go again, putting up mobile plans 6-7%, passing through inflation through to the customer base. Optus will follow, Vodafone will follow again. So identifying those markets where you've got oligopoly structures, pricing power, rational participants. We see Telstra growing earnings at over 10% per annum over the next 3 years. Not many think about Telstra as growing their earnings by double digits. So, it's a 4% yield, and that doesn't necessarily look attractive relative to where cash rates are today. But it's the growth in earnings that attracts us to a name like Telstra, and why we like the telcos generally as a from that bottom up perspective that I'm talking about, but also when you're thinking about those defensive characteristics. In terms of inflation protection, well, of course there's the energy names, which Woodside is our preferred play there, given the exposure to LNG in particular. But there's stocks like the insurers, and that acts as a good counterbalance to our big underweight in the Aussie banks. The insurers are putting up prices by double digits. I'm sure you and your clients have had their car insurance bills and their home insurance bills come through with a look of shock with 30% increases. This will all help the insurers' profitability and higher margins over the next couple of years. They also benefit from higher interest rates through their investment books. So, they're just a few areas that we think give you that combination of resilience, but more importantly that inflation protection.
Okay. Well, brilliant. I mean, basically, it comes down to a bit of pricing power, defensiveness of earnings, then of course valuation, because there's certain defensive everybody jumps into. And you look at like something like a Telstra, and that's shot up. And so do you want to follow the herd, or do you really need to think outside the box, right?
You need to think outside the box. That's right. I think as valuation still matters, our processing has a valuation discipline. It's why we don't own stocks like Woolies and Coles. And it's also why we've been trimming our Telstra position, because you're right, we bought that below $3, the stock's at $4.50. The potential upside return from here is a lot less than when we first bought it. But look, it's identifying good fundamentals, because ultimately, if you're buying good quality companies and on a 3 to 5 year horizon, you can get caught up in the short term macro, but what you want to buy is good quality companies that can deliver good outcomes no matter what the economic environment over a longer investment horizon. That's how you create real alpha and real money.
So some of the fundamentals, which is diversification, spreading it out, and just not following the herd, and always just time in the market, as they say. So.
Yeah, couldn't agree more.
Beautiful. Thank you very much for your time, mate. Thank you guys for joining us, and I will catch you next time.
Thank you.